Good morning, traders and investors. Roger Scott here, senior strategist for Wealth Press. Today is Monday. It's May 15th. May is halfway over. My kids are almost done from school. Two of them are already out of school, or one and a half is out of school. And it's almost summer. And honestly, I'm still trying to remember where half of this year has gone. Folks, it's about 7:33. The market's going to gear up to open up in about an hour and 57 minutes to be specific with you. And as I mentioned before, I might not have mentioned, my name is Roger Scott and I'm the senior strategist for Wealth Press. Now, I've got something for you guys to do. I want you guys to do me a favor. If you're enjoying these videos, like our YouTube Wealth Press channel. Post comments there. I respond to those comments, and subscribe to our Telegram channel. You can find the link to our Telegram channel in the YouTube channel link. Go to YouTube, type in Wealth Press, and you'll find the link to today's presentation, all the good stuff. It's all there. I posted myself right after finishing these videos. They're usually there at about 8 o'clock. Now, I want to see lots of comments from you this week. Folks, we're looking at the S&P and the Nasdaq before the market opens, and they're opening up pretty good today. The Dow's up about 123 pre-open. The Nasdaq's up about 36, which is kind of random. But the Dow's looking pretty good. 123 pre-opening is above random. Let's hope we can keep it that way. Why is the market up? Well, there's talk of the debt ceiling being resolved sooner than later. And there's more talk of bank stocks. So we're going to talk a little bit about both of them. First of all, I want to show you what's on the agenda this week. We've got a lot of stuff to talk about. Tomorrow, you've got retail sales. That's a big report. And you've got retail earnings all week long. You've got industrial production tomorrow. Today, you've got the Empire State Manufacturing Survey. It's not huge, but it is a report. But tomorrow, we come in hot with retail sales, industrial production. Then you've got housing markets. Then you've got jobless claims. You've got Philadelphia manufacturing. You've got Philip Jefferson speaking. You've got existing home sales. And then Friday, you've got Jerome Powell, Mr. Jerome Squirrely Powell, and John Williams speaking. Now, interestingly, as of beginning of last week, they were pricing into the bond market interest rate hike of a 0.25 at almost a zero chance. Now it's about 25, 28% chance. And if you notice, the bond market is not moving higher. It's actually moving lower. So I'm very nervous that the long bond is going to break this level right here. And if it does, it's going to put a lot of pressure on tech and consumer stocks. And as I mentioned, they are reporting this week. Let's talk a little bit about what we can expect this week and today, and then I'll get into the nitty-gritty. So market participants are awaiting an update on plans to raise the U.S. debt ceiling while bracing for a key speech from Mr. Squirrely Jerome, a.k.a. Powell. Friday's session, Wall Street averages closed moderately lower with the blue chips dropping to a one-week low. We were in consumer discretionary stocks, and we've been actually fairly safe keeping away from all of this gyrations. Consumer stocks, consumers discretionary stocks, were the biggest drag on the market as more than expected drop in University of Michigan gauge of consumer sentiment raised concerns over discretionary consumer spending. I have a huge red flag with consumer discretionary spending. I don't understand why those stocks are still positive, but they are, and I'll go through sectors before we tune out today. Financial stocks, that's another thing I'm going to be talking about, slumped amid fears about the stability of regional lenders, with Lincoln National dropping 4% and PacWest dropping another 3%. University of Michigan preliminary reading on Friday showed that the consumer sentiment index dropped to a 6-month low, and that's right ahead of earnings for a lot of consumer discretionary stocks, which are out this week. And this is after I've been telling you that consumer discretionary needs to cool off. It's way too hot. Weaker than the expectation of 63%, while a 5-year inflation expectation unexpectedly rose to a 12-year high. If that sounds like economy is moving in the right direction, let's go to Alaska and let me sell you some ice. I mean, that does not look like things are getting better. That looks like things are, in the best case scenario, staying status quo. Federal Governor Michelle Bowman said Friday the Fed will probably need to raise rates further if inflation remains high and the labor market tight. Well, I don't think the labor market's going to be as tight as she's thinking it will be, but I think inflation will be a lot worse than what she thinks it is. But do you notice she's not talking about pausing or anything like that? Right? She's not talking about any pause. She says need to raise rates further. She didn't say after a pause. So as of last week, the odds as priced into the bond market, you want to pay attention to this, were about 90-something% that the Fed was not going to take action. And I was very curious, and I even made a comment that I'm curious if that number is going to change or fluctuate. Well, sure enough, it's already at 78%. I don't remember what that number was last week, but I believe it was in the 90s. But it's now 78%. I would love to see this number. I don't know if I'd love it, but I think we're going to see this number get a lot lower before it's all said and done. I don't think the Fed is ready to not raise rates anymore, but they may pause for one time or another. Meanwhile, discussions between I don't know if he's still awake, Biden and lawmakers are expected to resume on Tuesday after being postponed on Friday. I wonder if that's because he needed a nap. Sorry, guys. Just Biden is a very easy target. Biden said on Sunday that he remains optimistic about finding an agreement with his Republican opponents to raise the nation's debt limit and avoid a default. The Congressional Budget Office warned on Friday the U.S. might face a high risk of defaulting in the first 2 weeks of June if lawmakers do not increase the $31.4 trillion debt ceiling, which I'm pretty confident they will, because if they don't, all hell is going to break loose. Market participants will closely be watching the Federal Reserve, Mr. Jerome Powell speaking on Friday, and I will too, for more insight into the future path of interest rates. Now, as of last time, he said we're not going to raise rates. That's still what the market's pricing in, but I'm looking at the market, and if this thing keeps breaking lower, Mr. Powell's going to have a lot of explaining to do and a lot of backtracking to do, which is easy for him. His middle name is Squirrely, right? In Europe, all eyes today are on the U.S. New York Empire State Manufacturing Index. I'm not expecting big numbers from that report, and I'm expecting the regional bank stocks and the debt ceilings to drive the market for the foreseeable futures. Results of earnings in Europe were results for the earnings season, as well as the outlook for monetary policy is what Europe is watching right now. Gains in mining stocks are leading the overall market higher. Keep your eye on mining stocks, because mining stocks, gold stocks, metal stocks, keep your eye on those stocks, because remember, a lot of that happens in Europe just because of that's where it all takes place. So we got to be mindful of that, because that may impact the U.S. market here. Well, at least that sector, the mining sector and the gold and silver sector. Eurozone March industrial production was reported at negative 4.1%, weaker than expected. That's not good. China, they closed higher after the People's Bank of China kept its medium-term lending facility at 2.75, in line with expectation, while injecting more long-term liquidity into the financial system. At the same time, expectations are rising that the monetary policy easing may be inevitable, and I agree with that, in the coming months to shore up the economic rebound, which is starting off much slower than they expected. I don't know why they were expecting to go gung-ho. I mean, they were in a COVID for 3 years. The Japan stock market closed higher, hitting an 18-month high as upbeat corporate earning results boosted sentiment. They weren't watching America for once. While the yen's weakness also lifted export-oriented stock. I'm actually expecting the export stocks to crap out and yen to get stronger with new policies coming down the line from their new chief. Data released on Monday showed their prime minister. Data released on Monday showed that Japan's production inflation eased more than expected in April. I'm actually expecting really big things from Japan in the coming years. Now, notice I said in the coming years, in the coming months, not in the coming days. But I think because they're going to shift their policy, their prime minister is going to create a higher interest rate scenario, which will shift away from export-oriented stocks into import-oriented stocks and yen strength and higher inflation and all that stuff we've been dealing with here in the U.S. You've had positive news for Albemarle, which gained 2%, and Charles Schwab rose more than 2% pre-market. So we did have some positive news. On the earnings front, you've got New Holdings, Monday, Catalent, Tower, Rumble. These are much smaller stocks since the big stocks have already reported, so there should be a lot less news on the market action based on what we're seeing right now. Now, one of the sectors that I want to bring your attention to is the U.S. Regional Bank ETF. Now, this has been really crappy, and a lot of these small mid-cap bank stocks are going to be coming out next couple of weeks with earnings, the ones that haven't come out yet. My suggestion is to go to their constituent page, ticker symbols KRE. Look at their constituent page, and here's all of these bank stocks. You could see each and every one of them. And if they're looking, like, for example, let's look at MTB, for example. Just as an example, this is the second biggest one. What I would be looking at for right now is I would be looking for these stocks to go up to like this stock to rally for about a day or two and then sell it. Rally for a day and two and sell it. And you can do this not just on MTB Bank, but you could do this on any of these KRE regional banks as long as they don't have earnings. But this is a low-hanging fruit right now, and you need to take advantage of it. As a matter of fact, if you look at the entire financial sector, which we'll look at right now, this has the large ones and the small ones. It's not looking all that great either, and it looks like we can go lower. But I'm a lot more bearish, not on the large caps, but on the smaller stocks, on the regional banks, because they're hitting lows right now. So I would wait for a little pullback to the upside. Maybe they'll get a day or two of good news, and then find the stock that had the most upside, little upside, baby upside, and short it. That's what you need to know there. Now, the bond market is also starting to peter out a little bit. And if you look at the QQQ, now, it made a swing high, right? But the bond market is going lower. If the bond market keeps going lower, I'm not expecting QQQ to make higher highs. That's not going to happen. Also, if you look at the performance of QQQ, and if you look right here, you will see, and this is something you got to pay attention to, only 53% of stocks are trading above the 200-day moving average. Here is the 50-day moving average. I want to show you this. Which way is momentum going? Higher or lower? Lower, right? It's moving lower. That's the 50-day line. Now let's look at the 200-day line. The 20-day, I keep saying 200. Let's look at the 20-day line. Notice this is going down too. That's moving lower, not higher. So what I'm seeing here is less stocks causing the market to go higher, which is called narrowing of momentum. And I'll talk about that in my VIP room today. But the bottom line is you still have swing highs, but the number of stocks that are making the swing highs is getting lower and lower and lower. The less stocks you have making highs, the weaker that sector gets and the more downside propensity it'll have. So be really, really careful, because even though the stock prices are moving higher, it's clear that there's less stocks causing the upside. And if you look at the broad index, you will see 49, 53, even the 200 only has 63 above, 63% above. And let me show you, they're not making swing highs. Moving lower. So every index is telling us that there's less stocks rallying in the next Nasdaq QQQ, something you need to pay attention to. As far as sectors, be really cautious with the financials, be really cautious with the energy. I do like utilities a lot right now. I'm starting to like industrial a lot more. I'm liking healthcare right now. I'm loving consumer staples. I think 2/3 of our exposure is in the consumer staples. Consumer discretionary is a dog right now. Real estate can go either way. Technology, this is the QQQ. Noticing it looks like it's topping out. I would be really cautious with technology, with communication services, and with consumer discretionary, especially with less of these stocks in the Nasdaq making highs, and with the TLT ETF, the bond market ETF, starting to head lower, and the odds of an interest rate hike are increasing once again. You saw it was near the 90th percentile on Friday or Thursday. Now it's at 78th. And one of the Fed didn't even mention a pause. So be really, really, really cautious right now. Keep your eye on KRE, and I'll keep updating you on the debt ceiling debacle and regional banks. And today, during VIP Room, if you're there, it's happening at noon, I'll talk about which regional banks are on the chopping block right now. Chopping block. Woo, ta, 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 ta. Chop them up. All right, that's my sound effects for the day. Folks, before I let you go, stocks are volatile and they're unpredictable, especially right now. Take a look at this year, last year, and any year for that matter. You'll see what I mean. But there's one market that's safer and more reliable than stocks. You guys are going to love that. It's not gold or real estate or anything like that. And it's much larger and older than the stock market. What is it? I'm sure you guys want to know. I gave you a lot of clues today, but I'm not spilling the beans. Find out with Celeste on Wednesday, May 17th, 2 days from now at 1 p.m. Eastern Time, this Wednesday. You can't afford to miss out. Sign up right now. This thing is going to get filled up and you may not get your spot. And that means no soup for you. I don't want that. Follow the link below. Check out Celeste, Wednesday, the 17th of May. Don't miss out. It's happening on Wednesday. Today is Monday. 48 hours from now. You don't want to miss out. And if you don't know where the link is, go to the YouTube Wealth Press channel. You can subscribe to all my goodies, leave comments, and sign up at the same time. And don't miss my VIP room where I'll be talking about regional bank stocks and the debt ceiling more in depth today. Have a great week ahead, and I'll see you soon. Questions, comments, emails, complaints, anything. Just kidding, complaints. Support@marketgeeks.com. Have a great week, and stay cool out there. It's getting hot. Bye.